What's the truth behind the mortgage cliff rumours? So this mortgage cliff, just before we jump in, for those that don't know, we have a very low fixed rate interest rate going into COVID, and throughout the COVID period, a lot of people move their variable rate over to fixed rate, and those are now coming off the minimum required fixed rate period, and causing potentially a mortgage cliff. So all of these people now with very low interest rates moving over to a higher interest rate all at once and causing dramatic mortgage stress across the community. So that's the mortgage cliff, and that's the concept. I might throw to you, Damian, in the first instance, if that's okay, just to answer, is this a thing? Are you seeing it on the ground as a very large mortgage broking business in Australia? And what potentially can we do to minimise the effects on us?
Really good question, and a very important one. There definitely were a lot of customers who took advantage of very low fixed rates. Rates as low as 1.99%
Yes.
for 3 years during the COVID period, and that was extremely attractive. And a lot of people did take that up. For the first time in Australian history, we had a lot more mortgages that were fixed than variable. Traditionally, Australia has a variable rate market home loan industry. And so, there were a lot of loans, probably close to 70% of all lending went into fixed rates during those exceptional times. Now, to give you an idea what's still coming off, because we've weathered a lot of the storm, there is probably, I think from RBA estimations, about another 400,000 mortgages coming off fixed rate between now and the end of June. Now, what does that mean? So if you look back, a lot of people actually were taking a rate. So to give you an example, March 2022, just before the rate period really started to accelerate fixed rates, you're just getting the hangover from the first increases to fixed rates. You were going to get something around about 2.49 originally, and then very quickly it turned to around about 3.19 for a 2-year fixed rate mortgage. So March 2022, 2.49 was originally advertised around about January or Feb. Rate increases quickly changed the market. You then ended up getting a 2-year fixed rate for 3.14. Still very attractive, and a lot of people took that up just to try and get ahead of the curve. So they're coming out at the moment. They're getting into an environment probably in the low or mid sixes. So, you're talking quite a bit more than what they were actually on, 3%. So, that's going to have an impact. But I think one of the reasons we probably haven't experienced a lot of carnage per se, which was maybe talked about from a mortgage cliff and a subprime market almost occurring, was that Australians had saved a lot in their offset accounts or just general saving balances. I think RBA estimates during sort of the back end of COVID, as they were starting to lift the interest rates, they had a comfort that they could do that because there was around $200 billion of offsetted savings against that people had the ability to draw on to sort of minimise the rising cost of interest rates. So, will it be detrimental? I don't think so, but it is actually something that's very active in our sort of marketplace, in our business. We are very acutely aware of our clients that are coming off their fixed rates, and we preemptively contact them to understand what sort of rate options we can get them into as they're rolling from a very low rate into, something as much as 3% higher.
Damian, when you say 400,000 coming off or coming into a mortgage cliff, I guess, before middle of this year, can you paint some colour around that? So you mentioned 70% had moved to a fixed rate through COVID. That seems very high to me. What would be the traditional fixed to variable percentage?
Generally the other way around,
Yes.
About 70% variable to around about 30% fixed is traditionally, unlike a lot of other countries around the Western world, America, the UK, predominantly a fixed rate market. So when you see the Fed Reserve, Jerome Powell lifting interest rates so aggressively, it's because there's a very little effect to most mortgage holders. Most mortgage holders are getting 30-year fixed loan terms. They're not impacted by the interest rate cycles. I found an interest rate that I liked. I can afford that. I've now locked in my mortgage lifespan for that rate. UK is very similar. So 10-year mortgages are very much common over there. And so, in Australia, we've been typically a lot more affected by variable rates. There's a lot less competition in the Australian mortgage market. And so, fixed rates tend to be quite high comparatively to what you can discount on a variable rate mortgage, and hence we see traditionally a lot more people in variable. trying to get the best discount.
So I'm just trying to do some mental maths here. So 400,000 coming off the mortgage cliff. How does that compare to the total number of mortgages? Are we talking 1 in 10 or 1 in 100, or is this going to be?
That's an estimate. There could be more, but that's just what's rolling off. If we go back to 2022, you could get a 3-year fixed rate mortgage for under 4%. So people were still opting for, I want that stability. I'll go for a, let's say, 3.99% 3-year fixed rate as opposed to the 3.14.
Yes.
And depending on what lender options were there, a lot of people were quickly getting into what was, probably the last of the low fixed rates. And it was rapidly changing. Every couple of days was a new increase announced by lenders on their fixed rate pricing, because that's not really associated with reserve cash movements. That's banks can make an amendment to their fixed rates at any time. Recently, we've just seen some banks like Macquarie drop their fixed rates. So it's totally out of cycle with what we see traditionally with the variable rate market.
Interesting. Did you have a comment there, Mike?
Yeah, look, some really impressive insights there from Damian. For me, it's simple. It was a beat up. The mortgage cliff. I mean, if you think about a cliff, right? It's a perilous thing where you can fall off and at the end you die. I think that was kind of the media beat up, is that we had all these borrowers on these fixed rate mortgages and they would fall off the cliff and the property market would explode and people would be selling at a loss. And I think it's not unusual of the media, of course, to paint a dire situation. But as Damian says, we've already gone through the majority of this. We've had this in the past. Or just before APRA, we had the fixed mortgages that were, the APRA intervention, and this is a similar story. It was a bit of a beat up then; it's a beat up now. I think the big difference is that we have huge savings ratio that was really kind of helped by COVID, right? Because not only did we have uncertainty, and there was a very short window of time where we were all kind of a little bit terrified. People were talking about 30% unemployment. People were talking about, do I buy canned vegetables or a shotgun? What is the world going to look like, right? So what happened is that people built a war chest, which is sensible, right? But then, of course, they realised that the sky isn't falling, and then they've got this money, and we saw an uptick in things like renovation and household expenditure. But, you couldn't go overseas, you couldn't go out to dinner, so people kind of sat on this cash. And I think the other thing in concert with that is that I think everyone knew in their heart of hearts, if they're fixing at 1.99%, that's not going to be forever, right? So a lot of people were paying more than the minimum. They were ahead, or at least their mindset was ahead of it for me.
So that's what you've seen as well, Damian. People have sat on that war chest, and we've got $200 billion sitting in offsets. So people haven't been paying the minimum fixed rate amount. They've really been trying to get ahead of the curve. And that's on everyone, obviously. There's going to be people that really are struggling to meet those minimum repayments on fixed. But you're saying, let's get ahead of this. Let's not make this a cliff. If there is any possibility of it being a cliff, let's minimise those impacts. And that's coming down to, a case-by-case basis. So each person's solution to minimising the impacts of fixed going to variable will be different. And your options potentially will be different as well. So there are some things that we can do, I think, is the takeaway. So we can agree, probably not likely for a mortgage cliff to be coming anytime soon, guys.
No, not in the sense of a catastrophe, that's for sure.
Okay.
It's a mortgage hill, a mortgage grassy knoll.